Hi everyone. Today's topic is about raising early funds for your startup. With me, I have my experienced colleagues Mukhtar and Helena. Thank you. And they will share some valuable insights with you on the topic. And I'm going to start straight away with you, Mukhtar. What is angel investing?
So angel investing involves high net worth individuals who provide capital in exchange for equity in a startup. So these investors, they play a crucial role in the early stage and really fueling the growth of startups. And I would say they fill a gap where traditional money doesn't exist. They are really important in the ecosystem, and you should really focus on having some form of relationship with these types of investors.
So the angel investors bring the gap in the very early stages for startup.
Mm.
And what would you say is the difference between angel investors and venture capitalists?
So the difference between angel investing and venture capital is that angel investors, they usually invest their own funds, and this means flexible terms and also an easier investment process. When you look at venture capitalists, they have limited partners, stakeholders that invest in their funds. And that could be pension funds, it could be family offices. And this means that they have very strict conditions and also a much lengthier investment process that would be a bit more difficult compared to angel investors. So that's the major difference there.
So if they are going to invest their money, they of course want to like the person they invest in. And Helena, I know that you quite often talk about relationships and building strong and lasting relationships. Can you just tell us a little bit about how startups can nurture these relationships and find them?
Yeah, relationship is a key. I mean, you want to have a long relation. You get you get in bed with the investors, and they want to know your challenges, how you reach your milestones, the success, and also if you have a failure somewhere. They want to be part of your journey and feel confident that you can fix everything that happens. And to be able to really have a long time relationship, you need to find them also. You need to go to conferences and events to meet them and to have an open door to invite them to really be part of the company. And it's important also that the investment and the investor, they will be able to reinvest in the company. That's also a very good thing.
So when you look at their network and meet them. Yeah. And we're actually being quite positive now, which we should be. But I can also imagine that there could be some risks in this, Mukhtar.
Yeah, sure. There are risks both for the investor, but also for the startup as well. For the startup, giving up equity means that you give up control of the company. Also for you giving up future profits that might occur in the company as well. And for the investor, I would say, according to the statistics, 9 out of 10 startups, they fail. And this means a huge risk for the investor as well. So make sure that you do your due diligence, both for the investor and for the startup as well, so that you make sure it's a good fit between you guys.
And when you say due diligence, what do you mean?
I could compare it to when you buy a car. You have to make an inspection to see that the car works well and that what you're buying really gives value to you as well. So that's the same with due diligence in terms of startups and businesses.
That's really interesting. So kind of inspect the investor. So before we leave this topic of angel investors, do you have any final advice for the aspiring entrepreneurs regarding angel investing?
I would say believe in yourself. It's really key, and have surround yourself with a good team. Also try to be persistent and make sure that you network and find people that you could work with. Also, when you find the actual angel investor, don't get stuck on valuations and stuff like that. Make sure that you see the added value and the benefits you're getting from the investor, which could be experience, it could be competence, etc. So there's a lot of value in having an angel investor on board early on.
So, of course, competence is also important. Helena, you are the business advisor and program manager at USC. That means you meet a lot of companies that pitch for you. What elements would you say are important for the company to think about when they want to do a compelling pitch deck when meeting an investor?
First of all, they should be confident and driven just to present. But then in the pitch deck, you really need to have the problem you solve, but not spend too much time on that. Very, very soon you go further and talk about go-to-market, the go-to-market strategy, show that you know your numbers, show that you are aware of the market, the competitors, and how big the market are, and it's a global market. Lots of facts give the investors confidence that you know about, and also what kind of money you need, so you have a long-term plan for what you need every year and what's your. Of course, you can't predict everything, but you can plan for it, and that's important for the investors to know where they have to step in and where they need the next round. So that's important, and the team, of course, it's very important.
The competence in the team.
Yeah.
Could you just elaborate a little bit more about the market analysis that you mentioned?
The market, it's very important to know the numbers for the markets and the growth for the markets, the potential for the market, the pricing. So you really, it's lots of numbers game here. And the investors want to make sure what to put the money in. So
I think it could be quite hard, because if it's a startup, they don't have any history.
No.
So how would you say you could evaluate your company without having any history?
I think it's hard. So usually, traditionally, when you value company, you look at cash flow. And since startups don't have any cash flow early on, it's hard to do any like calculated valuation. And there are other methods to do it, like comparables and looking at the industry and companies alike. But I would say try to make sure that you have a conversation with the investor, and it would always be like a negotiation. So you will talk and try to find a fit between, okay, what's the value that you're giving up in terms of equity, and what investment are you getting? So there is a delicate balance between those two. So it's a hard topic, and you can talk about it for ages also.
So I guess if we just take into account what you said, the market analysis, if you've done a good market analysis and, like you say, compared to others, it might be easier to look at the potential then. Thank you so much for sharing your insights. So be passionate, but also don't forget the risks. And before we end this interview, I just want to go back and bring some key takeaways up. So one of them was network with investors. You want to network with them, and you want to build relationship. And have a strong team. You have to have members in the team that complement each other, and have a compelling pitch deck. When you meet the investor, they, among other things, they want you to include the problem you have, the solution you have, but also go-to-market strategy. So thank you for today, Helena and Mukhtar.
Thanks for having us.